All right, welcome everybody. I'm very excited to get into another insurance. It's funny to say how excited I am about insurance webinars, but I legitimately am. We do these about once a quarter with our partners over at Vouch. Vouch is one of the organizations we work with pretty closely because they kind of share our philosophy of, an ounce of prevention is worth a pound of cure when it comes to the startup land, where you don't want to bury yourself in the intricacies of every possible insurance thing you could possibly need at every given point, but you just need a little bit of an assistance to understand when to cover yourself at the right stages so that as you're creating something valuable, you're ensuring that you're not risking it too much for your business. So Vouch's kind of specialty is in supporting that in a way that we really like in terms of Gust, and all of Gust's offerings are very much like give the founders exactly what they need at the right time that they need it, without too much expense or focus, because it takes so much focus to build a company. So I'm joined by Devin Wright today, who's going to lead us through kind of the whole up and down of what your insurance considerations should be as you're growing your startup through the various stages from the earliest to, as things kind of progress and you get growth. So as always, we're going to record this. We will send out recordings shortly after, maybe a day or two, with all the content. And I believe, Devin, you can probably make your slides available as well. Let me be sure you can
hmm
share your screen. And anybody who has any questions throughout the process, we'll have some time for Q&A at the end. Throw them in the chat, throw them in the Q&A functionality. I'll try to, kind of block and tackle anything that's like top of mind or bring it up to Devin and interrupt him. And then we'll have some time at the end. So without further ado, Devin, take it away.
I appreciate it. Thank you, Ryan, so much. Hey, y'all. Just a quick intro for me again. My name is Devin Wright. I'm a senior advisor here at Vouch. I have been working in the insurance industry for just about 20 years now, 3 years now with Vouch, specializing with early stage startups and kind of helping them with the connection between, their business and risk profile and kind of the necessary insurance coverages that early stage companies need. Um, so what I'm going to do is just kind of jump into this presentation here. It'll set a little bit of an agenda, and then I'm going to kind of walk through some different basic kinds of coverages that we typically see and typically refer to early stage companies, and I'll give a little bit of background on those and how they kind of relate again to what it is that their functionality is and why they're important for early stage companies. Let me jump in here and see if I can start this share. Of course, Zoom is going to give me a hard time about this. Let's see here if I can do this real quick. Come on. Share, open, Chrome. Oh, come on.
My favorite internet quote is the most impressive thing about Star Trek is that all the citizens of the universe have cooperative video sharing technology. Like just encounter an
I
alien
mean,
ship and hail them, and it just works perfectly. HD.
yeah, well, frankly, that would be the best thing here, but I don't know why it's not giving me the option here. So, yeah, I'm
I
just
have
having
it.
trouble with Zoom since we got rid of it, I guess. So this is kind of frustrating. Um,
I have
let me
it
see
open.
here.
Anybody should be able to share that's a panelist.
Okay.
We
Yeah, it
lost your
keeps
video, but I don't
just,
see a screen yet.
yeah, kind of just, okay. Man, it is not gonna let me do this for some reason. Here we go. Hold on. Is that the issue? All right. It's going to make me jump out and jump back in, I think.
All right. I will try to entertain the audience while you're gone.
Please do.
I think I have this is gonna work. That's gonna work. There we go. The weird hidden Apple reactions that they added 2 years ago that spooked a lot of us for a couple months. Sit tight. I think Devin, there we go. We got you back, Devin. You're muted, but let's see if you can screen share.
Yeah, now I can finally see stuff, which is very exciting. So let me get in
There we go.
here.
Something's coming up. There we are. Yes.
Cool.
Zoom is requesting to bypass the system private something.
Buddy. Well, we're
Oh,
gonna roll with
geez.
that.
There we
Great.
go.
Well, I
Got
hope
it.
we can see this, everyone.
Pretty good.
So finally we got there. Again, gonna just kind of briefly talk about de-risking your startup and in business insurance 101. Really quick, we've knocked out introductions here. We're just going to kind of start on some basic principles of insurance, kind of again, easy introduction to what management is versus mitigation. Talk about why insurance matters, when it's a great time to start looking for it, and then again at the end, we can handle any Q&A. Um, so some basic principles of insurance that, I mean, this is something that when I first started in the industry, this is like day one stuff that you were taught, at kind of the initial conference was that there are four options to kind of manage your risk. The first is acceptance, second, mitigation, third, transfer, fourth, avoidance. And really quick here, I want to touch on the two sides that you're seeing, severity and frequency. In the industry, we kind of refer to those um, as as a way that the industry kind of marks claims, which is frequency, the number of claims for a given insurance product, and the severity, which is generally the cost associated with that. Not to get too technical here, but frequency and severity are used by insurance carriers in order to help kind of gauge premiums and kind of set baselines for certain products and premiums. So, to dig in just really quick a little bit more on what these four types of like risk mitigation practices are. Again, if cyber is your business biggest risk, you kind of have a few options here. You can accept that it is, and you can continue on and just hope that nothing bad happens. You can mitigate the risk by implicating certain cybersecurity uh, uh, profiles. You can go for through SOC 2 compliancy, something like that. That's a form of risk mitigation. Transfer, which is going out and kind of transferring the risk onto a third party. In short, buying insurance. And then the other option is avoidance, which in this day and age, pretty tough to be able to do out there. Um, there we go. So, from our data sets here, who buys business insurance around company formation? Shouldn't be a surprise that most experienced founders start to buy insurance essentially from the jump. This is very important here because I'm going to kind of lay out what it's like for, purchasing at the beginning and then growing a program over time. But again, for the most part, experienced founders are going to be the ones out there purchasing right away. So insurance is one of those things that is always going to be a part of your business. In short, it is going to be there from the beginning to launch to things like equity raise until you start to scale. Business insurance is always going to be a part of essentially your life as a business owner. Um, what you're kind of seeing here is just kind of a basic fundamental foundation of your filing formation paperwork. You need to sign a lease. Maybe you hire that first employee or that contractor. These are going to be things where insurance are going to be required for those. Then you get to launch, and now we're talking about product launch, contractual requirements, those types of things. So again, insurance, your program is going to be growing again as your business starts to grow, and it's important to make sure that you're teaming with an advisor or a brokerage or an underwriting team who's going to be able to help you scale as you start to as well.
I really,
Uh,
actually, if you could jump back to that real quick, Devin,
yeah.
because this intersects with kind of the Gust Vouch overlap. I
hmm
love the way this is patterned, the passive insurance need versus the third
hmm
party push event. Most founders never, never consider insurance until somebody, and even Christopher is putting in the chat and Jim is sharing as well. They never even consider it until somebody else asks them to get it, right? It's like they try to get a relationship with a vendor, an enterprise SaaS company, or sign on with a given service, and they're like, oh, you should have X amount of coverage. And
Hmm.
the green here is kind of the proactive part. So like with Gust Launch, we incorporate companies in Delaware. We put as much liability protection on their COI as possible, which is that
Hmm.
formation paperwork. So it's like, and we also push them to make sure that they establish the board, appoint the officers, and grant stock, because that creates the corporate veil. However, once you start doing business, like that's good enough so that if somebody sues your company into oblivion, at least you're not going to lose your house or something
Hmm.
like that. However, once you start actually making business, and I think the most hilarious thing is literally just getting a lease or even a WeWork, you'll start to find that you need certain kinds of insurance coverages that are above just
Hmm.
what gets stamped on your COI. And I think that's why, one, we love working with Vouch because this $200 offering is sometimes enough for somebody to just get a WeWork, to start working out of, and be aware as they kind of march down the growth path, more of what they should cover up with because
Hmm.
the the COI is not good enough. It's pretty good for making sure that you don't lose your house, but it's not good enough for, all the people that you're going to run into as you're doing business and the more things that kind of unravel or I guess open up as growth happens.
That's right. Part of this and something that we try to tell our clients is that as you start to scale and grow, the complexity of your business is going to change, and the complexity of your insurance program is going to also. And again, that's why having a solid foundational partnership is so important because you want to be able to be there and have somebody who's just going to tell you, like, look, this has changed. This is why. This is what we're kind of looking at down the line. This is what we're looking at now, that kind of thing. An important part about insurance is just the real upfront conversation and sometimes a hard conversation as it relates to, like you said, passive insurance needs change, but also, those kind of push events also. Um, you just kind of have to be ready for those kind of conversations. So, a quick note about insurance. It is very rarely cut and dry. I am speaking more for myself in my 20-ish years in the industry and also some of the things that we do over here at Vouch. It is not the same for everyone. What I mean by that is agencies have different concepts and ideas. Underwriters have different appetites and who they want to write. Insurance companies all operate differently. So this is just one simple man's perspective and view, kind of on the industry as a whole here. So this next portion and these next few slides here, while we kind of have it organized in a way that I like to kind of look at it like a milestones type of event. So as your company incorporates what's going to be important for you from an insurance standpoint, why is it that it's going to be there? Um, and then we're just going to kind of walk you through this process a little bit. So you've incorporated the company, you have a concept, you've got a little bit of a team together. Now it's trying, for some people, it's like, well, we need to get together to be able to work into a space or something along those lines there. If you are signing a lease in an office, if you are signing on to like a WeWork space or something along those lines there, typically general liability coverage is going to be required of you to get into that space. Simple part of general liability coverage is that it is designed for property damage or injuries um, to a third party. What I mean by that is if you are offering product of some kind of way that causes property damage or injury to a third party. General liability is there for those types of lawsuits. But as it relates to the office and co-working space, it's more meant for um, people in the space, if they are coming to visit you or something along those lines, you're holding a small meeting or something like that, they slip, they fall, they hurt themselves, or if you damage the lessor's property in some kind of way, general liability is designed to help with those types of incidents. There is a little bit of confusion, I think, for a lot of people who think general liability means general business insurance or something like that. For the most part, it is a very specific coverage that has to deal again with property damage and injuries to third parties, In the most cases, that's clients, customers, things like that. But for, again, office spaces, co-working spaces, they're just trying to protect from any damages that may take place on their property. Again, simple kind of just what I mentioned here about general liability coverage. It's normally going to be required by landlords, banks. You're going to find too, a lot of times it becomes part of a customer contract. These are things that attorneys put into a customer contract stating that you need to have. I would say that 9 times out of 10, general liability in some cases may not be applicable for everybody, but it's one of those things we kind of talked about with that scale screen that I had on there. It is part of doing business. Um, so just something to keep in mind there. Usually these type of things are typically a few $100s for the year. Um, General liability too, how it is rated and how the premium is provided to or quoted is it's based on your industry, what it is that you do, and then that has a rater system in the insurance industry. Basically, every business out there, whether you're fintech or if you offer a product, physical product or something like that, has a rate. That rate then gets multiplied by your estimated revenues for the next 12 months, and that's essentially how your premium gets applied. A quick note as well. General liability coverage is audited. What that means is at the end of the year, your insurance carrier is going to come back and they're going to ask you for your revenue figures. If you said that you were going to do $1 million in revenue and you did $1.5 million, you're going to owe your insurance company additional premium based on the rate that they charged you. If you did $750,000 worth of revenue, the insurance company is going to provide you a credit either on your renewal or they're going to give you money back. The irony of all of this is you always want to owe your insurance company money for general liability coverage because that means you've exceeded your revenue goals for the year. There's something to keep in mind there. So, as I mentioned before, go over this one quick. Most of the claims that arise for general liability, it's things like slip and falls, device malfunctions, things like that. If you are offering a hardware type of product or a wearable or something like that, and it causes physical injury to a customer of yours, or it's like an Amazon Echo thing, and it like sparks and causes fire damage in somebody's house. That's what we're talking about for device malfunctions. Like I said before, slip and falls if people are in a space that you lease or own or something along those lines. Business property. Typically, this is baked into a general liability policy, but it is designed to cover the costs associated with damaged property that you own. Things like laptops, phones, the furniture in an office space, or something like that. Anything that you use to run your company is considered business property. Again, it's going to be required as part of a lease agreement. It's going to be required from the banks, things like that. A lot of times, this is easier to do and just have it on a general liability policy than it is for you to go out and get like an Apple Care coverage or something like that. Normally only costs you a few $100s, if that. The deductibles are usually small. And again, it's an easier process in order for you to help with the costs associated to any damage to your property. So again, we're talking about stolen goods. We're talking about, potentially if you have employees who are working remotely and you have coverage for remote workers and their laptop gets damaged or stolen. I live in Louisiana. If my house floods or something like that, and the company equipment that I have is damaged, they can file a claim in order to get it replaced. So now you're in your office space. You've got the product moving. Now it's time to start talking about employees. Um, this is very important because there are a few distinguishing things here, especially as it relates to coverages. They sound the same, but they are a little bit different. Employees outside of just things like the fact that now you're hiring people in, they're doing more things. This is going to relate to things like cyber and errors and omissions coverage, which we'll touch on later. But the two most basic coverages for this is going to be workers' compensation and employer's liability. as well as employment practices liability. Like I said, there is this funny coverage here. They both sound the same, but they both kind of operate a little bit different. Workers' comp coverage. Why does this matter? Um, it is required in every state for you to have. For example, the state of California, after you hire a second full-time employee, regardless of what state they are in, if you are operating in the state of California, you must have workers' comp coverage in place. Um, there are some states where that is a little bit different. All states, kind of operate this a little differently. Not to get too far into this as well, though, for some states, you cannot purchase workers' comp coverage through a third party. You have to purchase it through the state. So if anybody here is in Ohio, you have to purchase workers' comp for your Ohio-based employees. The goal of workers' comp coverage is if there is an accident or an illness that takes place while one of your employees is doing the everyday thing that they do for your company, and they are injured in some kind of way while on the job, this will help pay for the medical fees and billings and things of that nature for that employee. Um, for what's very important about this is that with again, I'm a remote employee worker. Like these things are require you to do a little bit of tracking as you start to hire people in different states. There's going to be management in that. You need to provide your insurance agents with updates about hirings, firings, things like that, just to let them know what's going on. Um, Similar to
Devin,
general liability. Yes,
I was going to say we got a good question in the Q&A. Is the
right.
workers' comp only for full-time employees? What about fractional staff, things like contractors and whatnot?
For the most part, contractors, 1099s, they are not subject or privy to workers' comp coverage. This is mostly designed for W-2 employees only.
And that answers Jim's question in the chat too. Thank you.
Cool, cool. Uh, Now, Jim, for some other people out there, there are programs for like 1099 employees. There are some available programs that are like direct. Um, that has been something in the industry that's been a little bit difficult to get off the ground. But again, for the most part, workers' comp is related to um, your full-time W-2 employees. Um, as I was going to mention, general liability coverage, it is audited. Your workers' comp is going to be audited as well. Workers' comp is based on where your employee works, what they do, what their payroll numbers are. That is how they come up with the premium. It's pretty universal across all carriers. Um, if you hire more employees than when you started, you're going to owe your insurance company some additional premium. If you let people go, you're going to get some back.
And where does Vouch sit with the workers' comp? Are you guys actually insured? Because I know a lot of people use PEOs
Hmm.
when they're
Great
early
question.
on.
That's a great question. So we have the ability to go to a third party insurance carrier and get you coverage. I typically suggest to my clients to go ahead and use a payroll provider or something like that. If you have somebody that you use, typically workers' comp coverage is offered as a service. Um, and the reason why I typically suggest that is one, the payroll company already has all the information that they need. As I mentioned, it's payroll, where do they work, what do they do? Payroll provider already has all that information. Plus, if you hire or let somebody go, you have to tell your payroll provider that. So the process of them being able to keep up with all the changes is more simple and easy. So it is a bit more of a user-friendly process than, again, using a third-party carrier.
Thank you.
Um, Quick note on workers' comp as well. A lot of times in contracts, you're going to see employer's liability. It is a similar coverage to workers' comp. So just keep that in mind because that is different than employment practices liability. One thing about the insurance industry that drives me kind of crazy, we will use similar terminology for different things, and it is kind of annoying. But that's showbiz, right? Um, so employment practices liability. This typically relates to incidents that stem from hirings, firings, harassments, wrongful termination, wage disputes, etc. For anybody out here that is located in New York, California, or Illinois, those are very litigious states as it relates to employment practices liability. And what I mean by that is they are very employee-friendly states. If an employee brings a suit against you claiming that they were unjustly fired and they may have done their job terribly, more than likely you're going to have to pay them something. Um, for states like California, for companies based in California, New York, and Illinois, we typically recommend that, after that first or second or third employee, you start to look at this coverage. For most others, we normally recommend it around, your fifth employee or something like that. Um, and again, this is one of those things, it's different in every state. So severity and frequency can be pretty different state by state. But again, I think we've all kind of seen that the tech industry has kind of gone through a little bit of a slow growth as it relates to more and more layoffs and things like that in the past few years. So again, employment practices liability becomes an important part of your program. Um, Again, as I touched on before, wrongful termination, potentially alleged discrimination based on a disability. This can relate to race as well and things of that nature. So just something to keep in mind here.
Yeah, I think if I can translate that a little bit,
Mhm.
we went through quite a decade of employees joining startups, literally hopping, especially I have a technical background, and like engineers are jumping jobs every 18 months,
Mhm.
for, another 20 grand in compensation, this and that. Everything was much more, I would say, liberal in terms of the exactingness, but it is a tougher job market. It's a tougher retention market. And I do think I think it's maybe not back to basics, but I think people are being a bit more exacting about their relationship with both their employers and their long-term career goals. So there is some more considerations for a company to be protected if somebody's feeling like right or wrong that they were treated unfairly during the employment process with their company.
I mean, Ryan, you're so right on that. This is in a way the tech industry has almost gone to like back to a more standard traditional kind of employee hiring type of model, bouncing around from companies to companies every few months or whatever it may be, it's just not as common anymore. And so the relationship is really being forged there between employees and employers. That can be a great thing, but there's also like the inverse of that. The longer you stay somewhere, you feel like your employees are doing a great job, but growth hasn't been there or something, and you need to let somebody go. um, that stuff kind of starts to be, if that stuff comes up, again, that's where EPLI is. But like I said, it's kind of back to this more traditional um, employee hiring model that has just kind of changed the industry a little bit. Um, so now you've got employees, you've got a product. Now comes the exciting part of being a business owner, and that's getting customers. Now it's time to start making money. Here's the fun stuff here. Um, As related to that, we're talking about now errors and omissions coverage. We're talking about cyber coverage. But with that comes key, what we refer to in the industries, and you're going to hear me say this, is exposures, contractual obligations, product failures. Now you have client data. What happens during a data breach? Negotiation requirements, again, in contracts, things of that nature. All of those become new risk exposures as you start to bring on clients. So errors and omissions, what is it? You hear a lot about errors and omissions. It's kind of coincides with things like professional liability coverage. Your attorney has a professional liability policy. Doctors have one. It's just called med mal coverage. I have a professional liability policy. If you are providing a service in some kind of way to clients, professional liability, errors and omissions are going to be extremely important because that is what's going to deal essentially with unsatisfied customers or clients. For example, if I tell a client, hey, I don't think you actually need this kind of coverage in place, and then a claim starts up from that, say I tell them, no, I don't think you really need cyber coverage quite yet. And then they suffer a cyber liability loss, they can bring a lawsuit against me. That's where my professional liability coverage comes into place. Essentially, what it is, it's going to help protect you from unsatisfied customers who either feel unsatisfied or if they have suffered a real financial loss through the use of your service. E&O coverage is always going to be part of a like an enterprise contract. It's always going to be in there. The reason why is important is because not only does it need to cover for, we're helping with litigation costs, but E&O is there if you're right or you're wrong, essentially. If you were really at fault and this customer did suffer a financial loss in some kind of way through the use of your product in any way, shape, or form, the E&O is going to be there for that. If they just feel that that using your service was frustrating, it caused them issues, something like that, they can still bring litigation against you for that. It doesn't have to be totally financially related. Um, E&O can help with those types of claims. So um, it is extremely important. Again, you want to keep your clients happy. Uh, Coverages and limits and things like that. This is kind of something that we tend to recommend based on, what your business niche is. What I mean by that is if you are operating in the fintech industry and it's related to people and money and things like that, you're typically going to have a higher risk profile than, say, an e-commerce site or something along those lines there. Um, with this is going to be cyber liability. E&O and cyber tend to be purchased together in a standard market, and that is because there is some coverage overlap. That they can provide that helps fill in gaps in certain spaces. Really quick, I'm going to talk about cyber liability first, and then I'll quickly talk about use an example of that coverage gap. Cyber liability, we're kind of talking about what you are thinking about in your head related to you now have customers, you have customer data. If somebody comes in and they want to get that data, they find a gap in your system in order to pull that data or something along the lines there. Cyber liability coverage can help with the costs associated with forensics, credit monitoring, defense and settlement costs for data breaches. Um, and one of the big ones that most people I don't think about as it relates to cyber liability coverage in early stage companies, the most common type of loss is really related to ransomware and phishing attacks. For most early stage companies, data hackers aren't interested in the data that you got because you don't have enough of it. But ransomware attacks, phishing attacks, those are easy to do because it's just some silly email that they send out and hope that somebody clicks on it. Um, Again, that is the most common type of loss that we see, and cyber liability is there to help with that. Um, Again, kind of what I mentioned with E&O coverage, costs associated with it, it varies. If you are working in financial industries, if you're working in the healthcare space and you have a lot of client PII or something along those lines, you should expect that your coverage is just going to be a little bit more because, again, you've got more sensitive data than some other more traditional industries or something like that.
Can you walk us through a bit? Because cyber is an interesting angle where
Hmm.
a lot of these other insurance policies are useful when litigation happens, right? A customer, gets upset with you and actually sues you.
Hmm.
But what does it look like in terms of if you get, if somebody, hacks your executive assistant's email through a phishing attempt and gets access and downloads your company
Hmm.
data and holds you to ransom, how
Hmm.
do you leverage insurance in that case?
Great question. The first thing you do is you're going to reach out to your provider. You're going to share with them all the information you possibly can about it. And then your provider is going to go through the claims process. They're going to help you out with it. What typically happens in a case of like a phishing or a ransomware attack, depending on policy wording, um, they should be there to be able to support not only the cost associated with paying the ransomware. Sometimes that may be require you up front. They pay you back right away. Potentially, they pay you for it. Again, insurance is a little bit gray on it. It depends on what your policy says. Um, and then what they're going to help also is they're going to go in afterwards. They're going to use a forensics team. They're going to find where did this come from? How did it get here? They're going to help pay the cost to upgrade a system or something along those lines as well. So not only are they kind of going to make you whole from the financial loss of the ransomware, but they're also going to help with the security of your system as well, which I think is kind of a great. Um, Nobody wants this to happen, but if you have a comprehensive program that's going to help shore up your system for you, I mean, that's in a sense, you can kind of look at it as money well spent.
Yeah, I think that's a good thing for startup founders, especially once they start
Hmm.
generating revenue, is I think a lot of people think of insurance as basically business insurance as the when I get sued protection. But when it comes to cyber, your cyber hackers are not going to sue you. They're going to try to, compromise your data, send you a ransom note, make you do a bunch
Hmm.
of stuff that's distracting from your company mission. But you can
Right.
actually view an insurance provider as somebody that can help you both mitigate and then overcome it, both financially and uh, operationally, I
Hmm.
suppose.
To touch on that a little bit further, the part about having an insurance program in place is now you have somebody who's back here dealing with all of this. You can still, once you get through the process, you can still kind of focus on the company itself, knowing that you've got the backing of your insurance provider back here who's, you know, e- essentially making you whole again, providing you with some additional and welcome information as it relates to those things like forensics, as it relates to this is where the gap was, this is how they found it, here's how we shored it up. So there is a lot of value add in that kind of thing. Um, Again, these are just a few examples of cyber and E&O claims and how they can arise. We kind of briefly touched on the hacker thing. I want to also touch on something else, Ryan, further to your question a little bit, and this is kind of as it relates to hacking, but um, I don't think a lot of people realize that if your client data is hacked, you can't just like shoot them an email and say, "Hey, bad news." Um, and we're solving it, we're working on it. You actually have to pay the costs to a third party that is going to provide all the information about the cyber incident, and they're going to send it all to all of your clients and customers. You have to pay that cost. It's called a breach response cost. Your insurance program will help with the payment of those costs. But again, you can't just shoot an email to everybody. You've got to pay for that. That's one of those sneaky ones that kind of gets on you. I think it's kind of an unrealized cost for some people. So we've kind of run through formation, employees, customers, and now we've got kind of these other coverages that come into play, and this is more based around the scale aspect of your business. When we're talking about other coverages, what can you expect coming down the line? Directors and officers is probably the number one. D&O coverage typically comes into play when um, companies are either looking for funding or they are in the process that they are going to get something, typically something more formal, like a seed or a Series A type of funding. D&O either becomes important to get on your own, or it's going to become a contractual requirement. Quick note on D&O: it's designed to help with the costs associated with claims, typically that stem from things like mismanagement of funds of those VC funds or something along those lines there. Or usually if you're, in a regulated industry and you somehow, some way violate an industry regulation and somebody like, I'm just going to use the SEC, for example, brings a claim against the company. It's designed for claims associated with those types of issues. It's a three-sided coverage. Coverage A is protecting the founders individually. So if the company isn't going to reimburse that founder for defense costs associated with, say, a mismanagement of funds or something like that, um, side A coverage is there to help with the reimbursement for essentially personal finances to an individual. And then side B and C are kind of more related to reimbursing the company should they have to pay out or any type of claim or defense costs. Um, Crime coverage, as it kind of relates to the growth of your company. If you start bringing in people that are going to be handling money, if they're going to be doing billings, accounts receivable, things like that, crime is there to help with essentially bad actors within the company who may be doing, something they shouldn't with the money. They're diverting it off somewhere else. They're creating fake invoices, things of that nature. Um, Fiduciary liability. If you are going to offer your employees a 401k plan, you are going to need a fiduciary coverage. Essentially, what that means is if you make a mistake in the implementation of your employees' 401k plans, like you forget to enroll somebody, you put in a wrong social security number or something like that, and they've lost funds because of it, or even if your company 401k plan doesn't operate like it's supposed to. Fiduciary liability is there for that. Quick note for people who want to provide ESOP programs. Fiduciary coverage is not related to an ESOP. You will need to go seek a specialized coverage for that because, again, ESOPs are viewed as a higher risk because typically you're managing the ESOP yourself. So just something to keep in mind there. Benefits liability, just what it sounds like. If you are administering your employee benefits and you make a mistake and forget to enroll somebody, and they get hurt and they go to a hospital and there's no benefits plans or they get a huge bill for their, dental work that they had done, employee benefits liabilities associated with that. And then media. This is becoming something that's bigger with the kind of increase in content creators and content creation and the easy ability to do that. If you are creating media and you're putting it out on Instagram, TikTok, YouTube, something like that, media liability is there for that content creation in case there is anything related to IP infringement or something along those lines. That can kind of help bridge that gap a little bit. It's added to an errors and omissions policy, which is a great place for it because, again, it's kind of related to the human error of your business. One other thing I want to note, because I feel like somebody's going to ask about it. What about AI insurance? What about insurance for my proprietary AI product? Um, that is something that the insurance industry is still a little bit behind on. And that again relates to frequency and severity that I touched on at the beginning of this presentation. The insurance industry has to see the frequency of losses and how much those losses cost in order to properly get comfortable with being able to offer a certain type of coverage. This was the same problem back in the 90s and early 2000s with cyber coverage. If you don't know the frequency and severity of losses, it's hard to be able to appropriately provide coverage and provide pricing for it. So AI in a standard insurance market, if there is an error that stems from your proprietary AI product, it is typically going to be an excluded loss, meaning you will pay for it out of product. I want to note here at Vouch, our partners at Corex do offer an endorsement on the E&O policy to cover things like issues that stem from your AI product, whether that's hallucinations, industry regulation kind of issues, or something along those lines, or a mix-up in data that causes client confusion or something like that. That endorsement is there to kind of expand that policy. So something to just keep in mind there. Um, so yeah, back to kind of what I mentioned here with us at Vouch. Um, I think Vouch, we do a great job of being able to provide a lot of upfront information for everybody. Our blog has a lot of specific content around insurance. It's very user friendly. It's probably maybe a little bit better explained than how I did it because it's a little bit more simplistic. Um, don't forget to by being part of Gust, if you go to the Gust landing page and you're interested in getting insurance coverage, make sure you go to vouch.us/Gust. That landing page is going to help lead you to our partnership discount with our friends over there. And then again, if you need to speak to an advisor, you're just interested in having a further chat, partners at Vouch can help you with that.
Perfect. We have just enough
All right,
questions,
just
I
a couple
think, to
minutes.
leave.
Cool.
Yeah, yeah, just to for the rest of the time, time ordered. I'll get to everyone in the chat, but I will honor the Q&A folks first. Christopher asks, has your team ever heard of an equity investor for a seed round um, asking for global finance guarantee bond insurance certificate?
That is something that I am aware of, but that is something that is very complex and very specialized. Um, I mean, if that is something that, Chris, you are operating in, I wouldn't say for early stage companies that that becomes quite the concern, but I can understand why somebody would ask for it. Bond, similar to crime, has to do with losses associated with essentially like theft in a certain kind of way. But that is a big ask, in my opinion. So I would want to get some more details about that. And then, if you have a current agent or something like that, I'd do some more research on it. It's a bit of a reach for an early stage company, but certainly something you may have to think about when you really get going.
Yeah, I would say candidly, not a lawyer, not an insurance advisor, not a tax
Yeah.
advisor, but in the seed stage, if somebody is asking for something that is that substantial, it's usually either a red flag that they are not fully aware of what a seed stage company operates like,
Hmm.
or there's something weird in terms of the request, or like it's a red flag or a yellow flag depending on the relationship. Because usually like a seed stage company would not have to would not have much of anything to
You're
show.
right. The other thing too with this, it also could just be like they talk to an attorney friend of theirs that works in,
Yeah.
like it could be as simple as that. But I would one push back and two kind of give them the old like, oh, that's interesting. You asked about that. Can you tell me more as to why you want something like that?
Always good. All right. And we got Joe Busby. Have you ever heard of ESG liability coverage? I believe ESG
ESG liability
sustainability.
coverage.
Yeah.
I cannot say that that rings a bell, but I must be missing something here. Um,
I know ESG is very popular in terms of funds and things in the last like 10 years, but I can't think of what the insurance element of that would. Oh, perhaps if the company is going to violate ESG regulations or something like that, if you could get
I
coverage around
mean,
that.
ESG, I guess it's related to like environmental securities or something like that. But again, I think that is something that is very specialized and kind of falls outside of kind of the norm for most. I can't say I'm familiar with it,
All
but
right.
now I want
And
to look
Joe,
it
if
up.
you're hanging out, I haven't heard of ESG coverage either. We got some ones from the chat. Da, 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 da. Devin, everyone wants to talk to you. So if you
Hmm.
have contact details or at least a
Yeah.
group email, you can throw it in there. We will, for anybody asking, we will share out the recording and the content from this in a day or two. We have John Tell. I have a medical practice and have all of the insurances discussed thus far. For
Hmm.
digital health startups, what type of insurance is
Nice.
needed when handling patient information and using AI? I think we kind of touched on that, but a couple people also asked about like HIPAA and PII.
Hmm. Hmm.
Any
Sure.
thoughts on that?
Yep. HIPAA and PII typically is going to be found within the cyber liability policy because again, you're protecting. PII. HIPAA is going to essentially anything related to that is going to require you to make sure that that client information is secure. Um, Something I kind of forgot to mention in my E&O and cyber piece here, and the way that the coverages kind of overlap and fill in gaps. If there is a release of client data because of a coding error or something like that on your side, that you didn't securely code something, or somebody was making a software update or something like that. CrowdStrike, great example of this. Um, if a software update or something like that releases client data, that's where kind of cyber and E&O come together. The E&O piece of that would have been the coding error, and then there is, of course, the client data release or something like that would be that cyber piece. Um, so again, if you're operating within HIPAA or a lot of PII, cyber is great, but I would strongly suggest just backing that with an E&O policy as well.
Excellent. And related, Christopher Clark asks, what types or are any types of PII that don't warrant coverage? So PII is personally identifiable information,
Hmm.
names, email addresses, physical addresses, phone numbers, etc.
We have a number of like, I wouldn't say that it's not that they're important, but I will say that they're rated differently. For example, we've got some clients and like what they do is they're kind of real estate facing, and they pull information off of something like Zillow or something like that, and then push that out to their clients to make, finding homes easier than a Zillow product or something like that. Or they pull it from an MLS, let's say. Like that kind of information that's more readily available, and easy to find. It's not that that's not important, but your rate is going to be a little bit different than if you're collecting, again, like client health information or something like that. So
Social security numbers.
exactly, all that kind of stuff. Or if you're like not if you're not encrypting it, or you're only encrypting a certain amount, things like that, that also plays a factor as well.
Excellent. Jim asks, does cyber insurance cover business losses if a contractor email is hacked and a payment goes to a fraudulent bank account?
Good question there. That would typically fall under if a contractor's, yeah, it will be dependent on your cyber coverage. I can tell you that Corix, the cyber coverage provided by our friends and our partners at Corix, and for the most part, mostly who we're going to be working with over at Vouch, they are going to be able to expand the coverage not only to your employees, but they're going to expand that to contractors as well. You'll also want to make sure that that is a worldwide coverage. And what I mean by that is if you have a contractor located in the UK or South America or something like that, you are going to want to make sure that your policy extends to that contractor in outside of the US.
So basically, cyber can cover that situation. You just need to be sure that you're upfront with your provider about it and you give them
Correct.
the terms. Because I imagine if you have a unknown Eastern European contractor hub that doesn't have a lot of information about how they operate versus some other contractor that
Hmm.
is very clear, has a clear, has their own security policy and things like that, that would change the nature of the coverage.
Correct. And a lot of times too, now you're going to find on a cyber and E&O application, they are going to ask you, do you have international employees? Usually they just want to know the head count for that. It's becoming a more standard type of coverage in cyber liability, but certainly something you want to make sure is in there.
Excellent. And we got 2 more minutes. Dan asks, what about key person coverage? Colloquially called key man insurance, but let's broaden that up. It should be key
Sure.
person insurance. For somebody who's a solo founder, very early stage, they don't really have other directors or succession planning, but when should they consider that? And can you speak a bit more about it?
Good question. So key person, something you're going to want to think about more as in a way, it almost falls in line with D&O coverage as a formal round of coming in or something like that. You may want to think about key person. I want to make a note. Key person is a life insurance program. So there's two essentially types of commercial insurance verticals, fire and casualty, which is what I'm kind of explaining here today. And then there's that life component to it. Life and benefits is typically what it falls into. Key person falls under that side. But again, something you'll want to look at once a formalized round of funding comes in or something like that. It's just a good idea to think about it, and it may also be asked of you to carry anyway.
Yeah, I think in my personal experience, again, not an insurance advisor, key person insurance is usually always externally requested. It's not something that you like suit up for to be like, haha, we're at the level of key person insurance. It's like somebody wants to make a big stake investment, but they
Hmm.
realize like, hey, you, one particular person, usually the CEO or the director or whatnot,
Hmm.
is so essential to this business succeeding that, I want a reverse lottery ticket on the hit by a bus situation in case like I'm into this totally, but like weird stuff happens and I want to be sure that if it does,
Yeah. You can
that
look at it as a form of flattery, almost in some kind of way. Somebody thinks
there you
you're
go.
so important that they want to make sure that there's something there.
Yeah. Ah, wonderful. We got a couple questions we couldn't cover, but do not worry. We will bring maybe Devin back. I would love to see you again, Devin. But maybe
Uh-huh.
Chris. We try to do these every quarter, really just get our founders up to speed with the insurance that they should be
Hmm.
considering. Check out Vouch, use that link that Devin shared, and we'll follow up with the recording and materials. Um, it's fantastic to just make sure that as you're building value, you cover parts of it, whether it's 200 bucks a year just to cover your WeWork, somebody hit their head on a desk, to once you actually start to build that real value and you want to protect it and capture it. Uh, we love working with you guys. Thank you so much, Devin, for your time today and all the great questions. Have a wonderful week, everybody.
Y'all have a good one. Appreciate it, Ryan, and thanks to everybody who's here and who participated. And I hope I helped.
I think you did. Thank you so much. Have a good one, everyone.